Hello and welcome to Scientific Beta webinars. I am Séverine Sibeli from the marketing team. Today's webinar is entitled Does ESG investing really have an influence on companies? It will be hosted by Felix Goltz, Research Director at Scientific Beta, and Eric Christiansen, ESG and Low Carbon Solutions Specialist at Scientific Beta. After their presentation, there will be a Q&A session where you will be able to ask questions using the raise hand sign appearing at the bottom of your screen. You can also submit your questions at any time during the presentation by using the Q&A function. We will address them during the Q&A session at the end of the presentation. Thank you. So I will now hand over to Felix and Eric for the webinar. Thank you very much.
Thanks, Severin, and thank you for joining us. So the question is, does ESG investing really have an influence on companies? And if you look at the definition of responsible investment of the PRI, where responsible investment is simply the incorporation of the ESG indices in decision-making in order to enhance the risk-return profile of a portfolio, this question actually sounds a bit irrelevant because basically they look at ESG purely from a financial perspective. Today, we're not going to take that financial perspective. We're going to look at ESG investment from the point of view of the impact it has on the behavior of companies. So does it really influence companies? And does different strategies influence companies in different ways? So, okay, so as Severin mentioned, Felix will join me at the end of the webinar for the second part. The first part is about divestment and engagement. So two different ways that investors can influence companies. And are these two different strategies mutually exclusive, as some people claim? Some people claim that you can't engage with the company if you're not a shareholder, if you have divested. And we will try to claim or prove, on the contrary, that divestment and engagement are not exclusive, but actually mutually reinforcing. In the second part, we'll look in particular at this question in the context of factor investment strategies. So if you want to have the financial benefits of a factor strategy, how can you incorporate an ESG policy with the objective of actually having an influence on corporate behavior? What's the best way of going about it, influencing companies from an ESG perspective, while at the same time having factor exposures through a factor investment strategy? That's the second part. So the first part about comparing divestment and engagement. Sorry, So why divest? As mentioned, there can be different motivations for divesting. Some people just divest because they want to avoid complicity. That's the most obvious reasons for divesting. You want to avoid complicity with harmful companies. Some people, as I said, take a purely financial perspective. So you could, for example, say that some risks have been mispriced. So, for example, you can estimate or view some assets, some companies as being stranded because their current market price doesn't reflect the actual risk that they incorporate. So either the risk can be underpriced, or you can simply say that, let's say you want to implement a low carbon strategy because you want to reduce your exposure to high carbon risk companies, and you want to hedge yourself against the carbon risk. So you're not taking the view that this risk is not priced. You simply want to hedge against this risk. And then you would rationally assume that you would sort of pay an insurance premium to hedge against the risk. So over the long term, you would expect to have an underperformance from gaining this hedge against a certain type of risk. But today we're not going to look at it from this kind of financial perspective. We're going to look at it from the perspective of how investors can implement an ESG policy designed to influence companies to improve the way the world works. And for example, how to implement a policy that actually helps in the fight against climate change, for example. Now, some people claim that if you divest, it's a pure capitulation. Basically, it's a passive approach. Some people call it a bystander approach, that basically divestment doesn't have any influence on corporate behavior. So we have a quote here saying that divestment simply transfers ownership from unhappy investors to a more willing one and does not address the underlying issue. So this is purely passive in the sense that nothing actually happens at the company level. they also even claim that it's actually worse from the stakeholder perspective, because you transfer the ownership of the company from an investor who might care about ESG, who might care about climate change, for example, to someone who doesn't care. Or you transfer the company from public ownership, from the scrutiny of public markets, over to private ownerships and to private owners who don't care about ESG at all. So the actual outcome of divestment, some people claim, would actually be worse than doing nothing. Now, what actually happens? Why is divestment an active policy from an ESG point of view? It's through the cost of capital. So by divesting, you push down the share price of companies, which is the same thing as saying that the cost of capital goes up, which makes it more difficult for company management to justify investment in new projects, because the hurdle rate, the required return, has actually gone up. So it hampers the growth in unattractive or unwanted activities. It also lowers the share price of stocks, which means that the stock options or share-based remuneration of executives is less valuable, so they have a personal direct incentive to do something about it. Now, how does this increase in cost of capital actually happen? There are two ways. First, there's the direct impact of divesting. So there's a shift in the supply and demand of the stock. So the stock price goes down at the point in time that you divest. But there's also a very important indirect effect, which you could call reputational damage, as these two researchers call it. Or you could see, let's say, in particular, collaborative investment campaigns, very vocal investment campaigns, are part of a normative process. So you create new norms in the society. In particular, you threaten the license to operate of companies. And this makes these companies rationally more risky. So since they're more risky, the cost of capital, the required return should also go up through this indirect signaling effect of divestment campaigns on the license to operate, and therefore on the riskiness of these companies. So there's two ways, direct and indirect. And this is very important today, because we're going to talk a lot about this signaling, this indirect signaling effect of divestment, and the importance of that, of having clear and consistent ESG signals to have actual influence on companies' behavior. Now, that's from a theoretical perspective. Now, let's look at it from an empirical perspective. Is there any, let's say, empirical evidence on the effectiveness of divestment? So there's this paper, for example, by Doherty and Weber, who look at different fossil fuel divestment announcements. And importantly, these are not fossil fuel divestments per se, but announcements that investors will divest. And they look at 24 different events. So it's an event type of study. And they show that during these divestment announcements, there is a negative abnormal return for fossil fuel companies in general. And interestingly, one of the most impactful events was when the Oxford University Endowment announced that they would divest. And this is a relatively small investor. So, but it had a very significant impact. And this just shows that yes, it is important to actually sell, and the bigger you are, the bigger the impact is when you actually sell. But the reputation, and the Oxford University has a reputation which is important, is also important in terms of the actual impact on the cost of capital and on the price movements. Now, this relationship between how many or what percentage of share owners divest and the actual outcome in terms of cost of capital is a bit difficult to determine precisely. There is some evidence that the link is not linear, in the sense that it's not purely proportional. So 1% more of the divestors doesn't translate into 1% more in terms of cost of capital increases, for example. So you might have very little impact until, for example, you reach a certain level, and some investors have, or researchers have pointed to a threshold of about 20% of investors needing to divest before you can actually empirically see an impact on the cost of capital. Now, 20% sounds quite high, but if you look at the numbers of AUM invested through an ESG strategy, and these are the numbers from the Global Sustainable Investment Alliance, show that in many markets, in many developed markets, we have already gone above 20% in all markets, and this is from 2018, probably the numbers are even higher now. In all developed markets, basically we're at 20% or above. In Europe, we're above or at 50%. In some markets, we're above 50%. But of course, the very important, the even bigger US market is still much lower at only about 25%. But overall, you could say that the ESG managed assets have reached this threshold of 20%. The problem, or one of the limitations, is that these investors have very different ESG policies. So they divest from different things in particular. But for example, if you take European investors, the numbers show that for investors in Europe who have some kind of divestment policy, 63% of these implement controversial weapons divestment policy, for example. So there is some convergence among investors on what companies to divest from. So there is probably or possibly some activities which have already felt the pain in terms of cost of capital. Controversial weapons, for example, in terms of cluster bombs or anti-personnel landmines, could be an example of an activity where we have already reached about 20% of investors already having divested. And interestingly, some papers also show to the existence of tipping points, meaning that there is a very strong non-linear relationship. So basically that at some point, there's a very strong inflection in terms of the rise in terms of cost of capital. So for some, at some point or up to some point, you have very little impact. Once you reach this tipping point, the impact could be very severe. So there's some papers showing this in theoretical modeling. Now, then there's this question about the compatibility between the two. So if you divest, and which we have shown to be effective, can you still engage with companies? Because engagement could be also a good way of influencing companies. So once you divest, have you actually made it impossible to engage with companies? And this is what some people claim. You have a claim here. Once a company is excluded, it is not possible to engage with it. So this is a claim you sometimes hear, that you need to stay as a shareholder to be able to engage with companies. Now, one widespread proof to the contrary is the existence of collaborative engagement campaigns, for example, through the UN PRI collaboration platform, or even you could see some engagement service providers as a way of combining the forces of different investors. And typically these collaborative engagements combine current investors with potential investors, so shareholders more generally. And they typically present themselves as representing X trillion of AUM. They don't go to each company and say, at this specific date in time, I have invested so and so many shares of your company. They represent a broad investor base who have certain specific goals. So this in practice means that we have proof that current but also potential shareholders do engage with companies and do it effectively. Now, in theory, this is completely normal. If you look at, if you think about public stock markets as any open public markets where buyers and sellers meet. So stock markets are where buyers and sellers of equity capital meet. There's no reason for sellers, and sellers in this case are the sellers of equity capital, meaning companies. There's no reason why sellers of a product on an open market would not talk to prospective clients. It would be a very strange salesman who refused to talk to prospects. Salesmen actually spend a lot of time talking to future prospects and not only to their current clients. So this might be a little bit different in private markets. If you are privately owned companies with a stable majority of shareholders, you might not, of course, talk to prospective shareholders at all times. But in public markets, the situation is very different. And there's actually no reason to believe that a company would not listen to future or potential shareholder more than their current shareholders. Now, so we've now made the argument that you can both engage with companies and divest and have a divestment policy. We actually will go a bit further than that to say that the two are not only compatible, but they're actually mutually reinforcing. The most obvious way that we can see that is that an exclusion policy makes engagement credible. If you are going to engage with a company and say, I disapprove of your current behavior, I want you to change. If you don't have at least the threat of future divestment, basically, if you don't have the threat to do anything about it, it makes this a very, let's say, the words are here, a hollow negotiating posture if you don't at least have the possibility to divest. And also, as we've argued, noisy exits. So noisy divestment campaigns make these divestment campaigns more effective. So if you're vocal about your divestments, if you're transparent about which companies you have divested from and the criteria on which you have based your divestment decision, it makes these divestments more effective. And this is the first argument we made. It's important to have an effective signaling on top of the actual selling. And last point here is that if you look at the success rate of engagement, how often do engagements actually lead to a change of the corporate behavior? What we show here, these are numbers from more than 1,600 different engagements led or coordinated on the UNPRI platform. So there's a large number of events that are studied here. What we show in the bottom line is that, or what the researchers show here in the bottom line, is that only in about 25% of cases, so 400 out of 1,600, only in about 25% of cases, the engagements have actually led to a success and a positive outcome from engagements. So given that in 75% of cases, you don't achieve the goals that the engagement was set out to achieve, it means that very often, if you want to remain credible in your engagements, at some point you need to divest at least from some companies, perhaps not from 75% of companies, because these topics might not be sufficiently severe to justify divestment, but at least you can't never divest if you want to remain credible in your engagement, because there is no such thing as 100% success when you engage. Now, so in this first part, we argue that divestment and engagement are both effective tools to influence companies, and we've tried to argue that not only are these two compatible, but they're actually reinforcing. It's good to do both at the same time to be credible and effective. Now, in this second part, we're going to look at this question specifically within a factor investing context. So we assume here that the investor wants to benefit from the financial added value of factor investing, and at the same time, they want to have an effective ESG engagement policy. They want to have an impact on corporate behavior. And we're going to look at the best way of achieving these ESG goals while benefiting from factor investment strategies. Now, these are the numbers also from the Global Sustainable Investment Alliance on different types of ESG strategies. And when we talk about divestment, we talk in particular about norms-based and negative screening policies. And when we talk about, we were going to show here also some examples of what we call mixing strategies, or strategies where you mix factor signals with ESG signals in an optimization process. So instead of having these two as separate objectives, so you implement ESG goals through screening, through divestment, and you implement then within a screen universe your factor strategies, you can have strategies where you mix these two. We call them mixed up strategies. They're very often called and this is the sort of official terminology, the ESG integration. So you integrate the factor signals and the ESG signals in one go, in typically through an optimization methodology. And what we see here in the numbers is that screening strategies or divestment strategies are still the most widely used. The numbers are still higher, but over the last few years in particular, you've seen a very strong rise in assets managed through these ESG mixing or integration strategies. And this is typically because they claim that you can have both of the best worlds, you can achieve both. The best way basically to achieve both is that you mix the two. And today we're not going to talk about the financial aspect. We're just going to show at this second claim that you can actually mix the two together and have a good ESG outcome as well. And we'll show some illustrations of how actually mixing the two together leads to very poor outcomes from an ESG perspective, because the signaling effect is going to be completely blurred. That's what we're going to look at right now. Now, so from an ESG signaling perspective, the importance of this signaling effect, the main benefit of screening or divestment approaches is the clarity of the communication. And this is something which is an argument in favor of exclusions or divestment, which is also put forward in this paper by Matt Sanderson, Patrick Bolton, and Frederick Samama from 2016, which was a paper on one of the first low carbon indices, which were launched at the time, and in which they argue here in favor of screening approaches to building a low carbon index, as opposed to, let's say, an optimization approach. So they emphasize the importance of having a clear communication, which is what we achieve through a screening approach. And they also, what we also highlight is that they make the argument that screening or divestment provides an incentive to excluded companies. So this is contrary to what we've always already seen, that some people claim that it doesn't create incentives. Basically, once you're excluded, nothing happens, or it doesn't incentivize companies to do anything because they've been divested from. On the contrary, what they claim here is that you provide a clear incentive to excluded companies also by divesting, since they have an incentive to do something about it, to be reintegrated into the index in the future. So clear communication and order to have clear incentives to companies. Now, on the contrary, so the signaling effect is clear for divestment, but the signaling effect is actually very poor when it comes to mixing strategies. And this is what Felix is now going to illustrate in some numerical examples. We're going to show how the divestment policy attached to a factor strategy compares with a mixed up optimization approach in terms of the signaling effect. And over to Felix, who will now look at the numbers.
Yes, thank you, Eric. So the question clearly, as Eric pointed out, is a question of the incentives that you are setting with an ESG strategy, and so the question is really, if you want to have an impact on companies, you have to send the right signals to these companies to provide some motivation for them to actually change their practices. And this idea of the role of incentives is, I think, clearly recognized by ESG providers. So here we're looking at the case of low carbon strategies. So ESG providers, for example, when they assess the carbon risk of companies, they don't just look at things like emissions. They also look, for example, at the compensation structure. So some companies have moved to actually providing at least part of the compensation that will depend on the reaching of objectives in terms of carbon reduction. So it's very clear that you have to if you want corporations to increase their carbon efficiency and to lower their carbon emissions, you have to provide some incentives. And so we're comparing here, or we're looking here at strategies that actually use a score weighting approach. And so this is a very popular approach of mixing both the carbon scores and other indexing strategies. And the question is, well, what are the signals that actually derive from this kind of strategy? And so the strategy we look at here, so we're going to look at two types of strategies, but the first one here is a simple strategy that starts with the cap weighted index, and then it's a tilt away from market cap just based on the carbon emissions, where here carbon emissions standardized by revenue. So we're just going to obtain stock weights just depending on the carbon intensity. And so we're going to move away from the market cap weighted index, tilting away or lowering the weight of stocks that have high carbon intensity. So that sounds, at first sight, like a strategy that could be reasonable. But when you look in more detail, you will actually see that this strategy is actually has some surprising side effects. And so what we looked at here is we looked at two types of indicators. The first one is the percentage of stocks in the index that are actually deteriorators. Okay, so what we call a deteriorator is a stock that has in the past an increase in the carbon intensity. And we're looking in particular at the percentage of these stocks that actually see an increase in their weight. So again, think about the idea of signaling. So what you're doing, of course, essentially in the strategy, you are in principle trying to favor the stocks with a low carbon intensity, but actually you may give an increase over time in the weight to some stocks that have actually become worse in terms of their carbon intensity. So we can see that over these different years. So we just rebalance the strategy annual, and you see that over these different years, almost half of the deteriorators get an increase in the weight. Okay, so think about the signal behind that. If, for example, in parallel to holding this index, you have an engagement strategy in place, and you're trying to convince the management of a company to do something about their carbon intensity and really engage in some actions to actually reduce their carbon intensity. And at the same time, what you've done in your portfolio was actually to increase the weight of this company. It's clear that you're sending a very mixed signal. And why would company management take your conversation seriously if at the same time as telling them they have to change something, you are actually increasing the weight you give to them, even though they have changed in the wrong way. Another characteristic we looked at is the percentage of now the worst emitters that get an increasing weight. And here we also see that depending on the year, sometimes almost 50% or sometimes even more than 50% of the worst emitters. So really the 10% of stocks with the highest carbon intensity gets actually an increase in weight over time. Okay, and so this is obviously just a consequence of the score weighting approach. And actually in the score weighting approach, there isn't any mechanism that somehow would ensure a consistent signal. So this is a simple score weighted strategy. Can we move to the next slide? And so here we see an additional type of strategy. So this is also something that is popular in the industry. So we're looking at a strategy here that actually mixes these low carbon objectives and also objective in terms of factor exposure. So exposure to traditional factors like value, momentum, size, low volatility, etc. Okay, so we're looking at first a strategy that simply removes 10% of the stocks that have the highest carbon intensity, and then we are comparing this to a strategy that actually optimizes. So the optimization strategy here again is going to mix the carbon objectives and the factor objectives. And what we're doing in particular is we're just going to target the level of tracking error that is the same as the filtering strategy. And what we're really interested in is this kind of strategy, this kind of optimized strategy. What are the kind of signals that this strategy actually sends to company management? Now, obviously, the objective here of this strategy is to actually get a given level of factor exposure, so a given level of high factor exposure, and also to attain a low weighted average carbon intensity. And so that if you will, that objective will, of course, to some extent, reduce the weighted average carbon intensity in that index. The point is that having a relatively low weighted average carbon intensity doesn't prevent you from sometimes increasing the weight in stocks that actually look very bad on these carbon characteristics, simply because things cancel out when it comes to the weighted average. And so this is something that you can see quite clearly in this illustration. So we're looking at the percentage of the worst emitters that have an increasing weight. And we're also looking at the percentage of these worst emitters that have a higher weight than even they have in the cap weighted index. And you can see that these numbers are quite substantial. So in some years, you actually give more than, or there's actually more than 60% of the worst emitters that actually get an increasing weight. And so again, think about signaling here. What you're basically, suggesting to companies is that, the stocks, so even though you're part of those companies that are the worst offenders, so you're really the most damaging, among the most damaging companies from the perspective of climate change. And guess what? I've just increased your weight over time. So how does that provide any incentive for these companies to change their practices? So it's clear that there is a problem in terms of the message that you're sending, and it's not clear why actually companies would actually change anything if investors are starting with these types of strategies. Then even if they engage, we argue that the signal will end up being so confusing that it's very unlikely to have a favorable impact. And so there's really a question for low carbon strategies and more generally ESG strategies, which is how do you make sure that you send a consistent signal to companies?
Okay, thank you, Felix. So it's time to conclude, and then after we'll go to to your questions. Hopefully you'll have a lot of questions. So in conclusion, we're basically, some people claim that divestment or exclusion or filtering, you can call it as you like, they claim that this is basically an old-fashioned strategy, and not only is it old-fashioned, it doesn't have any impact. So it doesn't contribute to, for example, fighting climate change, for example. But what we have argued is that divestment is actually effective, and that effect comes through the cost of capital. So divestment is not a capitulation, it's an active policy from the point of view of having an impact on ESG issues and the behavior of companies. Now, moreover, we have argued that divestment and engagement are not incompatible. So a lot of people claim that if you want to engage, you need to stay on as a shareholder. And once you have divested, you have basically lost all influence on company behavior. And we have argued that collaborative engagement campaigns are basically proof that investors can engage with companies as potential shareholders and not only as current shareholders. And let's say from a purely theoretical perspective, if you look at any public market, there's no reason to believe that sellers would not talk to prospective buyers as often as they talk to their current clients. Now, we have gone further than that. We have tried to make the argument that engagement and divestment are mutually reinforcing. So this means that, first of all, any engagement policy is completely toothless if you don't have at least a possibility of divesting as a threat. And also we have argued that divestment becomes much more effective if you have a noisy divestment, if you make it public, if you make it clear the criteria that you use and the companies you have divested from, what your objective are. So if you make that clear, loud, and public, it's more effective. And that's because the effect of divestment comes not only through the direct impact on cost of capital of the actual selling, but it comes through this signaling effect, the fact that investor divestment campaigns have an impact on the expected riskiness of companies because they are part of a normative process, they are part of a process of creation of new societal norms, and they can threaten the license of operator companies. So through this indirect signaling, there can also be a very strong impact on companies. And this makes this issue of clear signaling crucial when it comes to having an impact. And that's why we showed in the second part that one of the benefits of a screening strategy, a divestment strategy, is the clarity of the signal that you give. It's very clear. Everybody can understand. It's black and white, 0, 1. It's very clear what you're doing. You are divesting from companies whose behavior is inappropriate. On the contrary, if you look at mixing strategies or so-called ESG integration strategies, where you combine factor signals with ESG signals, for example, through optimization or some weighting approaches, this can, and that's what Felix showed, this can send very clear, very unclear and ambiguous and even completely incoherent signals. And this would make any kind of engagement unproductive, and it would lower the impact you have on companies. So this question of clear signaling for us is completely crucial, and it's one of the main benefits of having a clear divestment strategy as opposed to a mixing strategy. Now, over to the questions. So Severin, maybe you have received some questions, or we can take questions now.
Yeah, thank you very much, Eric and Felix. Yeah, actually, we received some question already by the Q&A function, and we also have somebody who has clicked on the raise hand sign. So just a reminder, if you want to ask a question, you can either use the raise hand sign or type in your question on the Q&A function. I will now unmute the person who has clicked on the raise hand sign, Eric Friedman. If you could please state your company name and maybe position, and we can, and if you can hear your sorry, you will be able to hear your question. Okay, I think he has no longer raised his hand, actually. So I will read a question that we received through the Q&A function. So the first question is there any evidence that companies care about whether or not they are included in an ESG index?
So Felix, maybe you want to answer that?
Yeah. So the evidence on inclusion, obviously, the question is important. So if you want to make sure that companies in a way react to their stock being excluded, you would want to see some evidence that that's actually the case. So there's different. So there is actually a lot of evidence which even goes beyond this ESG topic that yes, there is a strong index inclusion or index exclusion effect. So this is actually quite a old literature going back to the 1980s, and it's very well documented that companies, when they get excluded from popular benchmark indices, say the S&P 500 and similar indices that are actually followed by lots of investors, well, those companies that get excluded, they actually see negative, what's called an abnormal returns. So that basically means their stock prices tend to decrease around these announcements of the exclusion from the index. And if you will, that decrease is measured by adjusting the returns for any kind of sector effects, any effects of factors, so that they basically have a negative abnormal return, which is related to this event of exclusion. And what you can see, obviously, any corporate manager is trying to actually maximize firm value. So a decrease of the stock price is not what the corporate manager is trying to achieve, clearly, and it's usually there's a part of compensation that is related to the stock price. So obviously, corporate managers would not want to pursue a strategy that will reduce the stock price, right? So, and it's been shown that, again, index exclusions will actually reduce the stock price. So this has been documented for these very popular indices. Obviously, if only 1% of investors care about the ESG inclusions, this will not be expected to have a big impact. On the contrary, if maybe 20% or 30% of investors actually have these ESG benchmarks, then of course excluding companies from ESG strategies will have a similar impact as excluding them from these other popular strategies. So there's, at least the pretty direct evidence that exclusion from popular benchmarks, yes, companies do care about that, and the usual investor relations department, is usually very keen to be included in some popular index, and usually, does actually announce and proudly when it is part of a major index. So similar arguments apply here. There's also more direct evidence for exclusions from large institutional investors, where people have shown similar negative return effects when institutional investors announce that they have put companies on an exclusion list.
Okay, thank
Eric,
you.
you want to add something to this?
No, that's it.
Okay, thank you. So another question is regarding increasing the cost of capital. If one investor sells shares, are these not simply bought by another investor, therefore not affecting the company?
Well, there is let's say if there's no other reason for the actual divestment to happen, so nothing has happened in terms of new financial information, or nothing has happened in terms of there's no new, if there's no new information in the market, and suddenly one divestor decides for non-financial reasons to divest, that represents a shift in supply and demand. So the law of supply and demand basically says that the price should go down. So even though you have, yes, transferred from one to the other, since there is a shift in supply and demand, nothing else has happened in terms than the actual decision to divest, then in theory the price should go down. In practice, how big is that impact? What we have shown, or what some papers show, is that this relationship is not purely linear. Basically, it's not because there is, as you said, some level of just transfer. So it's not a pure linear relationship between each time one investor or one more investor divests that the increase in capital happens. There could be breaking points or tipping points, or there could be relatively high thresholds at which the effect actually kicks in practice. So Felix, I don't know if you want to add.
Yeah, no, I think the question is really relevant, because obviously, as kind of the question suggests, the share will be bought by the other side, and so it's just a question of so any let's say infinitesimally small investor will obviously not have an impact on this. But as you mentioned, I think in the presentation, there are reasons to believe that if there's a large enough fraction of investors really shunning certain types of shares, this will have an impact on share price and ultimately cost of capital as well.
Okay, thank you, Eric and Felix. Another question is, divestment is not an exogenous event. How can we know that it is divestment that drives the increase in cost of capital?
Yes, that's what makes, well, that applies to a lot of financial issues, but it's often difficult to disentangle the price. What actually drives price movements? Is it the divestment, or is it a specific divestment from a specific investors, etc.? It's very often difficult to disentangle what drives the prices, because there are so many different factors happening at the same time. So one approach to try to disentangle, to see what part of the price movement actually comes from a specific divestment decision, is to look at event studies. So you try to define a very narrow event, a very precise event in time. So a narrow event and a narrow impact on the price. So you look at, let's say, for example, the price movement over the next day, for example, at the time of this event. And one study, with the one we quoted, is about divestment announcements. So when big investors or influential investors announce that they invest, that's a very clear event, because you can time it, and you can look at what the impact on the stock price is on the day following that specific point in time. And then you can try to take away the other factors that have influenced the stock price. So you can look at, in this event study, they just used the market beta. So they try to look at what part of the price movement over the next day is simply the market beta of the stock and the general price movement. So you remove that, let's say, systematic part of the performance, and what is remaining then, once you've taken away these factors, it could be just a market factor, but you could also use, let's say, a multi-factor model to try to take away the systematic performance drivers over the next day. What is remains after that is interpreted as the impact of the actual divestment decision. But you're right, you have to try to take away, to remove other factors, and an event study is a good way of doing that, because you can sort of narrow down the time frame and that you're looking at. Because if you look at, let's say, a long period, etc., you will never know. Actually, there are so many different things happening over the long time, and that you can't actually observe it easily. Felix, I don't know if you have anything to add to that.
No, I think I agree. Yeah.
Okay, thank you. A person has I click on the raise hand sign, so I will now unmute her. Isabella?
Okay, can you hear me now?
Very well.
Okay, at first, thanks a lot for the great talk. If I understood you right, then you're saying that optimization does not really work well, because at the end, we end up with overweighted companies that are polluting a lot. And then your conclusion is that we should rather use exclusion criteria. But here I'm asking myself, why doesn't it mean that we should maybe improve the optimization method and not necessarily that the optimization itself is problematic?
Yeah, exactly. So the point we're making here is that let's say the popular approaches that we see in the industry, they don't actually address this issue, and so there's a severe problem that you may actually end up with increasing weights to the bad offenders, increasing weights to the companies that have actually worsened over time, and there is probably let's say a non-exclusive set of ways of addressing that problem.
Okay, and excluding those companies that do bad would be one way you suggest, because it works very easy.
Exactly, it's a simple way to do that.
Yeah, so
okay.
basically the point of an optimizer is to try to reconcile several different objectives. Now, if one way of, as you said in the beginning, one way to improve the optimization would to put a constraint on the optimization and say, okay, if the company is really, really bad, I just put a constraint that I want to divest from it. But in essence, that is a divestment policy. So you could, yes, add a constraint to the optimization, but that would essentially be, let's say, a divestment policy.
Okay, thank you. Another question is engagement equally effective for bond and equity investors?
Well, well, Scientific Beta is basically an equity index provider. So we, at least I haven't looked specifically at this question within bonds. I don't know if Felix, if you have any specific literature on bonds.
No, I think those are not aware with the empirical results, because we did refer here to quite a few empirical results. You can start obviously with the economic rationale behind that. So I think the claim that we're making here, that divestment will have a kind of strong impact on companies. So the argument behind that is simply that if you lower the supply of capital, you lower you have like a downward shift in the supply of capital, that will actually increase the price of capital, right, for those companies that rely on that. That obviously applies whether you talk about equity or equity or debt of the company. Then in terms of have people actually been able to measure that in the same way, I'm not aware of the empirical results. I think the same economic rationale would apply.
Thinking a little bit about it, it could actually work even better for bonds, because basically equity is a sort of a perpetual capital with no refinancing need. So let's say if you are a profitable company and you don't want to expand aggressively, you wouldn't need to raise new capital. So this question of the hurdle rate for new investment projects is a bit different, because if you're very profitable and you can self-finance projects, the cost of capital is not that directly irrelevant. Whereas for bonds, since you need to refinance periodically, this question, you can't basically self-refinance, because you need to go back to the market at some point in time and refinance. And then at the time of refinancing, the investment policy would maybe be even more effective for bonds than for at least some equities, for example, profitable equity companies.
Okay, thank you. I think we still have time for a couple of questions. So next question is, does selling stock of a company really raise its cost of capital? Isn't a lot of share insurance of larger companies to facilitate stock compensation programs?
Okay, so we have already gone through this question of does it actually have an impact on cost of capital? It depends on how many investors actually divest, and it also importantly depends on how credible the signaling effect is. So it's not only about the numbers, but how, and actually also who divests, as I mentioned the example of the Oxford University. So it does actually matter who and how you divest as much as how the percentage of AUM. Now the question on stock issuance linked to stock-based remuneration. I'm not really sure if I get the point. Basically, yes, you're right. A lot of new stock is raised, perhaps more to deal with the stock options than to finance new projects. Would the question be different depending on the purpose of the stock issuance? I'm not sure if the company, it might actually work even better, because basically if the stock issuance is only related to stock options, for example, it wouldn't be through the cost of capital, it would be through basically the share price would go down and would make the stock options less valuable. So the incentive is, the means through which the incentives works is perhaps a bit different, but I don't see why executives wouldn't care about the value of their stock options. That's why they're given stock options.
Thank you, Eric. Felix, would you like to add something, or can we go to the last question?
Yeah, let's move on to the next
Okay.
question.
So how much of the weight change to higher emitters is active versus drifts in market prices between rebalancing?
Yeah, so I can answer that. So based on, or that refers to the examples that we showed. So we can separate this quite clearly. So we showed an optimization-based strategy that actually doesn't have an explicit reference to market cap weights, and so the weight changes will be mainly driven by things like changes in factor scores, knowing also that we actually have some quite high frequency factors such as momentum. That's for the optimized strategy. In the score weighted strategy that we had, this strategy only tilts away from cap weighting based on the carbon intensity. Carbon intensity is quite persistent over time, so a large fraction of those weight changes would actually be due to changes in market cap of the stocks. So it would be a good part of the change in the example on score weighted indexing. It would be much more about active changes based on factor scores in the optimization based strategy.
Okay, thank you. Eric, would you like to add something, or could we conclude? Okay.
Yeah, we'll conclude on the next question. Or,
Well, we still have many questions, but I'm afraid we are running out of time. If that's okay with you, we will now conclude the webinar. So I just wanted to let you know that the slides will be available shortly, as well as the replay of this webinar. So you will be receiving a link to view the replay and to download the slides, as well as some additional research papers. So if you have any other questions, please don't hesitate to email us at webinar@scientificbeta.com. And for the people whose question didn't get an answer, we will email you also, so that you get sure to have your answer. So thank you very much, Felix and Eric, for your time, and see you next time at the next webinar then.
yeah, thank you.
Thank you very much.
Thanks.